All right, it's time to elevate your mindset. Today, we're going to completely transform you from a number-crunching accountant into a strategic C-suite leader. Because if you've been working through the ACCA Strategic Business Leader materials, you already know that thriving in a real-world boardroom, well, it requires a massive shift in perspective. So let's dive right into this critical question. Succeeding at the absolute highest levels of strategic management means demonstrating real commercial acumen, not just reciting textbook formulas. Think about it. A calculator can give you the net present value of a project, but a CEO? A CEO tells you what that number actually means for the very survival of the company. It's all about bridging that gap between raw data and your strategic vision.
Here's our boardroom itinerary for this explainer. We've got a 5-step diagnostic plan. First, strategic finance and investment. Second, mastering vital project management. Third, scorecards and performance management. Fourth, navigating outsourcing and offshoring. And finally, aligning your organizational structure.
Okay, Section 1, Strategic Finance and Investment. Let's see exactly how this builds your strategic foundation. Finance at this level isn't just about doing the math. It's about the story that math is telling us. We're starting with the core financial ratios, things like profitability, liquidity, gearing, and efficiency. But listen, the goal here isn't just calculation. Honestly, the board of directors already assumes you can divide two numbers. The real skill is interpretation. For example, a falling gross profit margin suggests intense price pressure, which demands a rigorous cost reduction strategy, or maybe a pivot to product differentiation. The numbers are just the symptoms, right? You are the doctor making the diagnosis.
Take a real-world dilemma, like investing in new solar panels. If you only look at the pure finance side, say an 8-year payback period with a marginal net present value, you'd probably just reject the project. But factor in environmental, social, and governance goals, and the whole narrative flips. You attract green investors, you boost your brand reputation, and you avoid future carbon taxes. What looks like a bad financial bet suddenly becomes a massive strategic win. Not everything that counts can be counted, but you absolutely have to consider it.
Moving on to Section 2, mastering vital project management. We're transitioning from deciding what to invest in to actually getting it done. Because, let's be honest, a great strategy on paper is totally useless if you can't implement it.
Initiation, planning, execution, monitoring, and closure. Sounds incredibly simple, doesn't it? Yet this is exactly where major strategic initiatives, like rolling out a massive new IT system, completely fall apart. And they rarely fail because of a technical software glitch. No, they fail because of poor governance at these very stages. We're talking unclear scopes during initiation, missing risk logs during planning, or just terrible communication during execution.
It really boils down to this. Strategy without project management is a dream without a plan. If you want to fix a failing project, you don't go out and buy better software. You implement strong governance. You appoint a project board. You establish a steering committee. And you demand continuous business justification. That is exactly how you turn those strategic dreams into reality.
Section 3, Scorecards and Performance Management. Now that your project is running, we need to figure out how you measure its ultimate success. Basically, are we actually winning? Okay, let's dig into the balanced scorecard. This framework is legendary because it stops you from managing only what you can easily measure, like pure profit. By splitting performance into 4 vital perspectives: financial, customer, internal, and learning and growth, you're forced to ask holistic questions. Sure, the financials matter, but if you're cutting employee training just to hit those financial targets, your learning and growth metrics will tank. That eventually destroys your internal processes, which ultimately alienates your customers. See? It's all connected.
Let's apply this to a luxury hotel scenario to make it concrete. The key financial metric might be revenue per available room, but for a luxury brand, differentiation is quite literally everything. So you can immediately see how checking staff training hours under learning or monitoring check-in speed under internal is just as vital to the overall strategy as looking at the revenue. If the strategy is luxury, those non-financial customer metrics matter just as much, if not more, than the basic cost KPIs.
Section 4, Navigating Outsourcing and Offshoring. With our internal metrics set and monitored, it's time to ask a really tough question. Should we even be doing all this work ourselves?
Now, people actually mix these two up all the time, but they are completely different strategic moves. Outsourcing means handing a function, like your IT help desk, over to a third party. You get their specific expertise, but you risk losing control. Offshoring, on the other hand, means moving that activity to another country entirely to reduce costs. And that introduces completely new risks like language barriers and time zone delays, which require careful mitigation, like demanding overlap hours and monthly reviews. Remember this golden advice directly from the source material:
Outsourcing is a marriage. Date before you propose. Seriously, don't hand over your entire supply chain on day one. Pilot a small function first. Write incredibly tight service-level agreements and maintain rigorous performance monitoring.
Section 5. Aligning your organizational structure. We have to cover this because even the best financial plans, project management, and outsourcing strategies will completely fail if your internal structure is fundamentally broken. Think about it this way. A functional structure works perfectly for efficiency, while a matrix structure cures the disease of regional silos. If your strategy is cost leadership, a traditional functional structure, separating HR, finance, and marketing into their own lanes, is fantastic. But what if you're a global company with regional branches that never talk to each other, resulting in zero global purchasing power? Well, then you need a matrix structure to introduce cross-functional teams that drive rapid innovation and flexibility.
Which brings us to the ultimate rule of thumb. Structure follows strategy, not the other way around. You absolutely must diagnose your strategy first. Are you aiming for differentiation? You'll need the flexibility of a matrix or flat structure. Cost leadership? Stick to the efficiency of a functional structure. Never, ever change your structure without first understanding the exact strategic goal it's meant to support.
You know, throughout this entire explainer, you've actually been applying core professional skills: skepticism, challenging assumptions and demanding evidence; commercial acumen, constantly thinking about profit, cash flow, and the customer; analysis, breaking down complex, messy information into digestible parts; and evaluation, weighing the pros and cons to make justified judgments. These 4 skills are exactly the difference between merely passing an exam and truly leading an organization.
So, as we wrap up, I leave you with this one final challenge. You have the frameworks, you have the tools, but when you're actually faced with a business on the brink of collapse, will you just act like a parrot repeating textbook definitions? Or will you step up as a true strategic leader, diagnose the real problems, and confidently chart a path to success? The boardroom is waiting. Keep thinking strategically, and I'll see you in the next explainer.